There's no feedback on this thing. There's no way I can tell I'm connected or everything's working until you guys talk to me. All right, so we're a little bit early, but just getting myself organized. It's been an exciting trading day already. And we've been playing with the oil, of course. That's been our major focus for the day. But we're getting a nice bounce in the indexes, which I just happened to call right on the button for the TZA. So I'm very thrilled with that. And we'll go over some of our portfolio positions. We'll talk about some hedging ideas. We'll talk about what we look for in these kind of rallies. And we'll talk about whatever you guys want to talk about, because I don't have an agenda. Maybe I should, but I don't. So I find that any plan you set down sort of falls apart in the middle of a trading day, you know what I mean? Because, like, you know, who knows what's going to be important at 1 o'clock on a Tuesday. It just depends where the market's heading and what's going on. So I hope everybody had nice holidays and all that. Hey, oh, shoot, what happened there? Oh. I touched my screen accidentally, and it's a touch screen. It knocked the thing off. So I hope everybody had good holidays and all that. I did. I love family holidays. How are things looking? We got... Man, we hit that TZA on the button. Jeez. Twitter is popping up. Twitter's having a very good day. What's that say? 3.5%. BT's having a terrible day. They're down 2.5%. Tesla's down again, but still holding 205. Netflix 322, Amazon 295, failed that 300 line finally. And GMCR still won't go down enough for me. All right, whatever. All right, 5 more minutes and we'll get started. I'll do my official reading of the disclaimer and et cetera, et cetera. But if anyone has any questions right now, I'm happy to answer it. I was just ahead of myself this afternoon, so. It's a very weird thing about doing chats and things like that, because even on our own website, where with the members and all that, we only have like 90% of the people never talk at all, and in any given day, 10, 15 people talk, and that's it. It's really weird to me. I mean, I'm one of the people who would always be chatting, so it seems to me it's odd when people don't chat. So James says, when will we get enough bounce to go long here? Looking at TNA. Well, you remember, you're just coming in for the free thing. We just, in fact, at 11:50 on the Russell, called a long. We didn't call a long. We were short, so we took off our shorts. Had I been on the ball more, we should have called a long right there also, because it's a perfect place to play for a bounce. The question is, though, how much of a bounce are we going to get? Yeah, the thing is, when you hit a solid line like that, there's two things. You hit a solid line at 11:50. You know that's going to be strong support. Okay, we've been playing the Russell from 12,000, I think it is. Hang on a second, let me check my chart. What's that? Okay, so on the Russell, 1140 is 5% below 12,000, okay? But the 1150 is psychologically a support position anyway. It doesn't matter that it's not in the 5% rule. It's still 1140 is a psychological support position. So you expect that after a 50-point drop from from 1200 back down, you expect to see some support at 1150. If there's no support, then you're very, very bearish. So it's a question of, like, we expect to bounce, but now the question is, since you fell 50 points from 12,000 to 1150, the question is, hang on, let me just double check that. Well, actually, it fell from high. It fell from like 1220. But, effectively, the must-hold line was 12,000, so 1,200, so we care about that. And we fell from the must-hold line of 1,200 to 1150. All right, and 1150 is essentially where we would have bounced to if 1140 had held, so that makes it a weak bounce line. So we expect a bounce there, and we expect a bounce of roughly 10 points. And I'm not doing the exact, I'm just saying like roughly 10 points. So you want to see a bounce to 1160. But if 1160 fails, in fact, we're right there right now, we're just right about 1160. If 1160 fails, then all you've got is a weak bounce on the way down. And you expect weak bounces. There's always a retracement. You go down, you retrace, you go up, you retrace. Things don't go in a straight line. There's pullbacks in each direction. That's what the 5% rule is for. It's to guide you through the pullbacks and give you an idea of what to expect along the way. And we'll do a little charting and stuff on that too, so I can give you guys an idea. And let's see, Craig says, well, I'll start with you officially after we do the disclaimer, because now it is time. All right, so let's get this thing going. And we'll do it officially. All right, go drink of water first. So, access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Okay, great. Now, what the hell is going on? Oh, I got to share my screen. Hold on. Let me get this stuff set up, and we'll be ready for it. Share my desktop. Oh, and as usual, I'll be totally surprised at what comes up. Dun, 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 dun. That doesn't look good. Oh, there it goes. A little slow today. Okay, there's my chat box. I can see you guys. Fantastic. Okay, now you don't want to see this screen, though. You want to see something more interesting. We'll start with this one. All right, so this is the Thinkorswim screen. As you can see, we've been screwing around with the oil all day. 39 trades. I don't know why it's 39 by 30. Anyway, so 39 trades or 39 different entries of some sort. I'm left with 10 long at an average price. Well, this says 48.16, but it's not really, because Thinkorswim messes up. Once you start trading in and out of stuff, it starts messing up on you. Realistically, I think about 48.35 is where I started this last batch. And so I'm 10 long at this price. We're up 3,600 still for the day. I was at 5,000. I was not 5,000. I was at 4,500 at one point, or close to 5. No, yeah, no, I was up almost 5,000 at one point. So it cost me $1,500 to work my way into this position because we started taking longs here, but it kept going down and down and down. So I just bought more and more and more, and now we sort of got to this point where I got some out even. All right, and we were doing a play-by-play basically in member chat while we were doing it. I don't really want to go back to being too long because we're getting too close to the close. And it's possible that the API report, the inventory report overnight, is taken as bad news, and that could send oil down like $1 or $2. And that would be like a $20,000 loss. So I certainly don't want to have 20 positions and take a $40,000 loss overnight. By the way, I say loss, it's not like I would, the point being that if I take a $20,000 loss, I would buy, try restarting for sound. Okay, so back to, anyway, so our premise is that there's going to be a drawdown, our premise is based on the fact that on the NYMEX, they canceled all the orders for barrels to be delivered to Cushing, Oklahoma this month. None. Usually there's at least 20 million barrels coming in. By canceling all of the orders into Cushing, they're going to create an artificial shortage of oil of roughly 4 million barrels. Now, we've had builds of more than 4 million barrels, so it's possible this is not going to be enough to show any kind of drawdown. There may be an actual, this may not be enough to stop the glut. Even though they canceled all the orders, they only usually order about 20 million barrels or 30 million barrels. So, you know, just cutting that out may not be enough to stop the glut of oil we've been seeing. That's one problem with this trade, but we think it's going to make a difference, and we think they're going to show a draw. And if they show any kind of draw in oil, we think we're going to get back to 50. And if we get back to 50, this is going to be a huge trade. It'll be good for like 20,000 bucks from where it is now. On 10 contracts, I mean. So I'm willing to risk a bit of a loss because it could be good. And of course, if it goes up from there and goes to 55, then you're talking about $100,000 or $50,000. So I like this trade here. I think it's a really epically good opportunity to go long on oil. And we just pressed it. We just pressed our bets in the short-term portfolio and in the $25,000 portfolio. This is it. If this fails and it fails and it's a loss, then we move on and don't trade oil because it's completely collapsing. If it works, though, then it's going to be fantastic. It could be a great trade. All right, so Craig is saying, oil question. Do you buy more than one contract as you go? I'm buying one at a time. Yeah, but you're too tight. This is your problem. As a rule of thumb for going in, I don't want to, if I enter at, for instance now, again, this is no good though, unfortunately. If my average is 48.35 on 10, I don't want to buy another one unless it moves my 10 a nickel down. So that means that right away I know I don't want to buy another contract unless I'm at 47.85, 50 cents below, because I have to move 10 contracts down a nickel. So I want to make sure I'm moving, I buy 50 cents lower my next contract to bring the average down by a nickel on all 11 contracts that are left. So does that make sense to you? In other words, you don't want to be too aggressive with your ads. You only want to add if you get a significant move down. And also, you want to reduce back down. Whenever you get a bounce back, you immediately want to reduce. So at some point here, I had like 16 longs or something like that at some point when it was down around 48. Now, I was down a couple of $1,000 bucks, but I had 16 longs. As soon as we got back to 48.35, way up here now, which is, so we're moving down the other way. When we got back to 48.35, I dumped half my longs, or not half, I dumped the 6 extra longs that I didn't really want. I was just buying them to move the basis down each time. And you have to keep track of that also. It's like, don't fall in love with your position. You know, you're only doing this stuff to get out. Now, by the way, you see what happened? We had a bounce, and this is that weak bounce I was just warning you guys about. We had the weak bounce on all these things. It's not even a weak bounce, and they all failed. So now we're back to a sell-off mode. All right, I don't know what's going to happen now. I don't know why this is happening. I don't know what the, I didn't see particular news on it. Let me check a look on my other screen though, just to see if anything exciting is happening. If you guys hear anything, please let me know. Bayard says the utility sector is totally overpriced. I know the CES show is nothing. I know there's really nothing going on at the CES show. Bill Gross says the good times are over. We know he's been saying that for like a month. Boeing delivered a record amount of planes in 2014. Nothing particularly in the last hour that I see that's anything exciting. Oh, the thing killing oil today, by the way, is the Saudis. Saudi's King Abdullah, who's like, I thought he was about to die. He's like, I think a week ago he was about to die. So he's like delirious in a hospital, and he's blaming that the slow global economy and not an oversupply of oil is why crude oil prices are dropping. Well, what the hell's the difference? Either way, there's too much oil. Whether you blame it on, I'm not sure what his logic is there. I mean, if you have too much oil, you have too much oil. You can blame the slow global economy, or you can blame the oversupply of oil. Either way, it's an oversupply of oil causing a glut. They lowered their price again on what they sell oil for, even though there was a false report the other day that said they were going to raise it, and that's where we are. So basically, we're reacting to an event today, and whenever you're reacting to an event, and you can say, oh, that event made my prices go down, you can assume that, I mean, unless the event is a game changer, but if the event is like somebody said something that you already kind of knew, then generally you're going to drift back towards about the middle of where you'll get a drift back towards neutral on the price after a day or so. So you have to look at that too. But that's bad news. Brent crude fell below, well, they're right at the $20 line. That's a really significant line on BNO. On Brent itself, I think it's like at I think it's just above 50 or something like that. It's just barely above 50. And if they break the $50 line, that's a big deal. It matters a lot more what Brent is and what West Texas crude is, because West Texas crude is just a U.S. thing. Brent oil trades the entire planet. All right. So my average is lower, Craig, because I scale in it much. I'm much more patient with my scales. I don't add a position unless it's going to move my other positions down a nickel. Okay, that means I'm usually waiting. When something goes down, I mean, first of all, as soon as it goes below my price, I'm already saying I intend to stick with this thing until it goes down. So in other words, when I was just talking to you guys about this, when I was at 48.35, and that was my average price, I know I'm not going to add any more until 47.85. So unless I'm willing to stick with it to 47.85, and look at this loss piling up too. So unless I'm willing to stick with the position all the way down to 47.85, then I wouldn't be in it in the first place. Now, 48 might be bouncy, but I really don't want to add anything at 48. If 48 is bouncy, it's going to go back to where I want it, and I don't care. So I'm not greedy here. I only care if it goes down to 47.85, which is basically where it fell to before, which is way down here. It's like a long trip. If it goes all the way back down here and tests these lows again, then I'm willing to add a few more contracts. And then hopefully, each one I add will bring my basis down about a nickel. So I'll drop from 48.35 to 48.30, and then 48.25, and then 48.20, maybe by adding like 3 or 4 contracts. And at 48.20, I'm going to feel pretty good about getting a bounce that allows me to get back out of those contracts even. And what have I accomplished? I've lowered my net basis on what's left. That's all I'm ever trying to do. You know, and you always have to remember that the only reason I'm doubling down is to get back out and lower my basis. All right, Mike says, I think we know oil inventories will show a drawdown, but can really be big, but there can be big buildups if you're a producer and now need to pump twice as much to keep the cash flows on. Yeah, but it's not that easy. It's not that easy to ramp up production. And clearly, if you look at the news that's coming out on the shale guys and everything, people are cutting they're dropping rigs. The rig count's going down. Now, when they say the rig count's going down, it's not a big deal. There's 3,000 rigs and 19 less rigs are pumping today. But still, it adds up. There's 19 less here and 19 less there. So every week they're dropping about 20 rigs. It'll take for a year before that's really significant. There has to be 1,000 rigs. So in other words, when you start out with 3,500 rigs in operation, And when they say, oh, the rig count's down, they're talking about 20 rigs going down this week. That's a lot in a week. I mean, usually it's 1 or 2 here and there. But in a week, when you have 20 a week, you're still going to take forever. You're going to take months and months and months before you make a significant dent. But you got to look at the numbers. You say, well, 3,200 rigs or 3,000 rigs, let's say 3,000 rigs pump out 9 million barrels of oil. All right, so that's going to be 3,000 barrels per rig per day. Okay, so that's 3,000 barrels per rig per day. So if we've lost 100 rigs, that's gonna knock out 300,000 barrels a day of production. So we're going to go from 9 million barrels a day in the U.S. to 8.7 million. But what's the real number that matters? 300,000 barrels a day times 7 days is 2.1 million less barrels per week. All right, that's all you got to do is you got to figure out, you got to learn how to do the math on these things. And it doesn't have to be exact or anything like that. Like I'm saying, I'm just ballparking, but it's about 3,000 rigs. And so if they take 100, if they take if there's 3,000 rigs that are pumping 9 million barrels, and each rig pumps 3,000 barrels a day on the average. And therefore, if you take 100 rigs out of commission, that's 300,000 barrels a day that are taken out of commission. And so over the course of a month, we've certainly lost at least 100 rigs. So between December and now, we're going to be down 300,000 barrels a day, which is 2.1 million barrels a week. And then you look at the prior inventory report and you say, well, we're going to be short 2.1 million barrels because the rigs are down. We're going to be short 4 million barrels because they didn't order any oil in the NYMEX, and that's going to be net negative 6 million. We're probably going to have a draw. It's going to be incredibly odd if we don't. And then you've got the Christmas time. You got to look at the airline traffic and the driving traffic and so on and so forth. And you look at all these numbers together and say, there was more driving, there were more auto sales, so more cars are on the road. The airlines had really good capacity, so those numbers were up, and they're using a lot of fuel. People are filling up their heating oil. That's another drawdown, because home heating oil this time of year people who have oil heat. Still plenty of people do that. They have to fill up their oil heaters, and as soon as it starts, they might not do it until the holidays or right before Christmas, so they don't want to spend their money, whatever. But bottom line is, by January, people are damn well going to get those oil heaters filled up, and especially with the lower price of oil, people are probably rushing to top off their heaters. So you got to think of all these things. There's a lot of factors. There's no simple thing. There's a ton of vectors involved. But all those things point to a very, very good chance that there'll be an apparent build of demand. And that's all these guys need is they just need to see the light. It's like you're throwing a life preserver to a drowning man. I mean, these oil guys have completely lost faith, and they're selling everything. And if you saw, and imagine the negativity in the oil market now, and imagine how many shorts there are in oil. These guys have to cover it. We pop back over 50, you're going to see all kinds of short cover, and we can get a hell of a rally. So I'm just kind of excited to be in a long position right now. I think it's a good time to be in a long position. If it doesn't work out, we could still collapse even further. But you know what? Not on the futures because you'll get killed, but on USO and stuff like that, I don't mind rolling those down and rolling those out in time, and I'll invest another 10,000 here and 10,000 there on the USOs, because eventually oil won't be $20 anymore. Maybe it won't be this year, maybe it'll be next year. But if oil goes down to 20, that really has got to be the bottom. There's a certain limit. You can't, these wells can't function. You're not going to see all the wells come offline in a month or two, but after 3 months, 6 months, a year, people are going to go bankrupt. George Bush bankrupted 2 oil companies in 3 years when oil prices went down. He ran 2 oil companies into the ground. He screwed one up, and his daddy helped him out, and they got another one. He screwed that one up too. So, it just, and they're oil people, and they're supposed to know what they're doing. When you have price drops like this, you've got fixed expenses. You just can't run the well, and that's true not just here, but it's true in the North Atlantic, up in Europe where the North Sea oil is. It's true in all kinds of places. It's true in Russia. Everybody's got economics. There's a limit to how much you can say, well, we'll just pump more. And that's being used right now as logic. They say, well, if oil's half price, they'll just sell twice as much. Who are you going to sell it to? The demand is inelastic. Okay? You can't flood inventories. People won't buy it. And that's what's happening now. It's driving the price down. All these guys who are trying to cover, the guys who need $60, all right, not 60, let's say it a different way. Iraq sells 3 million barrels of oil a day. Okay? They sell it, now let's say they sell it to $60. That's $1.8 billion. Wait, is that right? 3 million times 60, 180. Sorry, it's $180 million a day. So Iran is used to getting, it's going to be 180 times 30. So that's 5,400. I'm sorry, 5.4 billion. So every month they expect to get 5.4 billion to run their country from oil sales. Now, if oil sales go down to 40, you might say, well, Iran then is going to pump, to make up for it, Iran's going to pump 4 million barrels a day to get the money. It doesn't work like that, though. First of all, they don't have 4 million barrels a day. They're pumping all they can. It's not like they don't want the money. So they're already pumping all they can. And second of all, there's no demand for it. Who are they going to sell it to? If there's already glut, and that's the problem, you can't just it's like, imagine if everybody you knew already had skis, and you make skis, and now nobody wants skis, so the price of your skis goes down because there's no demand, right? So what are you going to do, make more skis? That makes no sense. There's no logic to that. I don't understand why people don't get that commodities and commodity producers, they operate on the same economic principles that any other producer does, any other manufacturer. You produce a commodity. There has to be a demand for it, or it just goes into your warehouse. There's no magic things. The problem is all these idiot analysts on TV, they don't know shit about oil. They don't know anything about the industry. They don't understand it. All they are is they're just armchair economists who've never actually been out in the field, and they don't know anything about it. And they spout off this bullshit about how, like, oh, well, they'll just produce more and then they'll flood the market with cheaper oil. It's like, where? Also, where are you going to put it? There's no room in storage for this stuff. We're full. Our strategic petroleum reserves are full. Our commercial reserves are full. China's strategic petroleum reserves are full. Europe's strategic, everybody's full. That's why we have a glut. I was telling people this was happening a year ago. Not even a year ago, in July, when oil was $110 a barrel, $107 a barrel, I was saying to short it because this was going to happen. It was so obvious that this was going to happen because they were flooding with oil, they were overproducing, and they were filling up all the inventories. This is a snapback. But now that we snap back, I'm telling you it's getting too low. But it doesn't happen tomorrow. Over the next 6 months, oil will go up. It's a fact. You're at a price now where people can't afford to pump it out of the ground. That's going to shut down production. That's going to bring the price back up. But not tomorrow. It takes time. All right. Craig says, I hate the average pricing. Yeah, I just watch this number. I say, am I making a profit? I like to look at that. Did I make any money? So as I said, though, this is terrible. I mean, this is 3,500 down from my high of the day, but I had the position I wanted. That was the key. My goal of the day was to get to this position. I expected to be down $3,000, $4,000 in this position. So being up $1,500 in this position, I'm totally thrilled. That means these contracts are free, essentially, as long as we don't go down any further. And anything up from here is profit. What is BNO? BNO is Brent. If you're playing oil seriously, you might want to do this. I'm going to really need to watch that right there. It's BNO dot, what is it, IV? Thank you. See, BNO.IV, that's like the Brent contract futures. I'm sorry, it's like the BNO futures. But it's always trading, so it doesn't shut down. Like regular BNO shuts down at a certain price. But BNO-IV just keeps trading all day long along with the oil. So when you can watch it, and obviously, if you see how similar these patterns are, well, let's see if I can square up the time frames. They should have the same time frame now. They don't seem to, though. Why would that be? No, they do. Okay, you just can't see the Friday here. Okay. So more or less, anyway, they're the same kind of time frames, 5 minute, 5 minute, right. All right, so you get the idea that you can see how similar the movement is on Brent and oil. So basically, if one does something the other one's not doing, you say, I think one's got to catch up with the other one at some point. All right, so it's a very, very good idea to keep your eye on Brent while you're trading oil. It's also a good idea, I'm going to mess up all my charts now. It's also a good idea to keep your eye on the dollar, because the movement of the dollar has an effect on oil. So when the dollar goes, in fact, when the dollar goes down, then oil is likely to go back up a little bit. You know, it's just on an intraday basis because oil is priced in dollars. So you can keep your eye there. And if you want to have another thing to look at, Exxon is always good to look at because they sell oil and they're incredibly liquid. So you can keep an eye on Exxon also, and that's going to give you kind of an indication of where oil is going to be trading. So if Exxon suddenly gets happy, you got to figure they're happy about the price of oil. That's like the main thing they're going to be happy about. Brent, you want to see Brent holding this $20 line. It's not good if they're below it. Oil, obviously, we want to see that holding 48 if we're going to be bullish. The dollar, we'd like to see lower. The lower dollar is going to make oil more valuable. And Exxon, we certainly want to see them holding 89. They don't look too bouncy, but they bounced over here. See, they bounced at 89.50 on Monday, and here's Monday where our low was down here. I'm sorry. Here we were at 48.50, not Monday. Sorry, here's Monday. We were at $50 when Exxon bounced on Monday. So if Exxon bounces here, that means I don't think Exxon thinks that oil is going to be lower than 50 for very long. So we'll see what happens. All right, and like I said, this is not enough to motivate us to add at this point. I really need to see 47.85 before I want to add anything right now. And okay. Saudi Prince said he was fine at any price again. Well, they can say that, and frankly, it doesn't matter what the Saudis say. They only, and everybody acts like they're magical people. They only produce the same as we do. They produce 9 million barrels. That's 10% of the world's total oil is produced by Saudi Arabia directly. The rest of the OPEC countries may not feel that way, but the Saudis are usually the swing trader who are going to lower the supply. And yes, they do have, they can afford this. They can ride this out. They're just like a company that has a lot of cash, and it's a bad part of the cycle, and they're going to ride it out to the downturn. And hopefully what Saudis are hoping for is they want to see their competitors go out of business. They want to see other oil producers, like the shale guys, go out of business so that'll dry up the excess oil, and then they'll sell their oil for more money. That's their plan. And they look at it the same way. Now think about their losses. Though. The losses are pretty extreme. They are selling 9 million barrels a day. Let's call it 10 million barrels a day. They were selling for 100. So that's what, $1 billion a day. Is that right? 100 times 10 million. Is 100 million a billion? Yeah. Okay. So they're getting $1 billion a day. They're getting 30 billion a month. Now at 50. They're getting half, so they're losing $15 billion a month. But it's like saying America's going to go bust because they're losing $15 billion a month. $15 billion a month, Congress lights that on fire for breakfast. That's not a big deal. It's a big deal in Saudi Arabia. They're a bit smaller of a country. But let's say it was Apple Computer. Apple's got $400 billion in cash or something like that. No, I'm sorry, about $200 billion in cash. So Apple could afford to lose $15 billion a month for quite a long time. Saudi Arabia's got a lot more money than Apple. They probably got at $500 billion, $1 trillion laying around somewhere. So they can go a year at these prices before it really hurts them. But they don't want to. I mean, nobody wants to, but the bottom line is they can afford it, and what they're assuming, and look, they have economists just like we have economists. They sit there and they say, the best, in fact, my cousin used to be an economist. He used to be an oil trader for Saudis. So they run these numbers themselves, and they say where do we want to be? What do we want the basket to look like? And they want to put things out of business. First of all, they want to put solar projects out of business. They want alternate energy out of business. They don't want people buying electric cars. They want to sell oil at the highest possible price. So whatever they can do to achieve that goal. And so at some point this year, somebody decided, we're getting close to a buy point on oil. So at some point this year, they decided they were going to let oil slide. And that's what they're doing right now. And everybody thinks it's over, it's over, it's over. It's never over until there are actual adjustments to be made. So this could go on for a few months. I think there's going to be a nice spike up on inventories in January. But after that, I'm not going to be long again. I probably might want to go short again. They're going to be a temporary thing. But we've oversold. We'll correct up a little bit. Then we'll probably drift back down because I don't see this thing changing in the near future. Can't. Bush was a big help. You're right. And you said 47.85. Yes, I do want to add positions at 47.85, and I don't know if it's going to hold, so I'll buy one here, just in case we don't get there. So I'm a little impatient. Now you see down 2,600 bucks. That was quick, huh? But that's because I have such a heavy bound contract. So, you know, when you have this many contracts, you have to be aware of the fact that you're going to lose 2,000 bucks in 10 seconds. You have to understand that's how it works. You don't go into this if you don't intend to play the game. So I was a little worried that we won't get below 47.90, so I picked up one just so I feel like I did something. But I'm really not. I'm not inclined to do more unless it goes lower, which I know seems self-defeating. But I've already got 10 longs. I don't need more. And if it doesn't bounce back by the end of the day, I'm going to get out before the API because I don't want to have more than 10 into the API. I'm not really prepared to lose more than 10 or 20,000 bucks. I'll be very upset if I lose 20,000 bucks on that, because after I lose 20,000 bucks, then I have to double down because that's my plan. If API turns out bad and it goes so badly that oil spikes down $2 and I lose $20,000, then I will want to buy more and lower my basis by $1. And then I better get what I want out of the next inventory report, or I'm going to just take a big loss. So Chrissy says, confused on API and EIO. Yeah, EIO. API is American Petroleum Institute. They do a report on Tuesday nights. Their report, though, is very haphazard. All they do is they call up people who have oil depots, and they say, how's your barrel count looking? And the guy just tells them, there's no official count or anything like that. EIA does an official government count. So API is an industry report where they're just taking an estimate, kind of like the what's that other thing? What's the ADP? It's like the ADP jobs report. You know, it's like it's a quick estimate, not based on a full sample, and they're not, you know, it's not their job. They're just giving you a good idea of what's going on. But also API works for the oil company, so you can't trust them anyway. It's like they're going to spin things the way they want to. The EIA, on the other hand, is the official government count, and they are doing a very, very thorough count of how much oil is available at Cushing, Oklahoma. But that's it. But it's also a small sample. They're sampling one terminal. But that's how come the oil companies can mess with the count, because they can then manipulate how much oil goes into Cushing and cause an artificial shortage. And that's what's happening tomorrow. They're going to cause an artificial shortage in Cushing tomorrow. Steve says, still, bear in mind that this would be a reduction in future production growth, not necessarily existing production. Yes, right. That's what I said. It takes 3 to 6 months for any of this stuff to have any effect. There's no short-term fix on these things. And then things usually go too far the other way. Is there a better place to see Brent pricing, not BNO? Oh, like I said, Craig, this BNO IV is a live contract that's much easier to follow. When you get time, can you discuss the ABX trade? What ABX trade? Oh, I can't believe I'm caught up on comments already. That's really good. All right. So my question is, what ABX trade? And then we can move on. So what do you got, Pat? All right, when did I add that last one? Was it 47.90 or 47.95? I forgot. And Chrissy says, if I understand, you're expecting a artificial shortage to result in a price jump in CL. Yes, what I expect tomorrow is that the EIA report at 10:30 is going to show a draw in oil. Certainly in oil. Who knows what in gasoline and distillates? But distillates, like I said, with heating oil stuff, you probably need a draw in distillates too. So you have a draw in oil, draw in distillates, probably at least not too much of building gas because people were driving. And aviation fuel is also distillates. So there's a couple of reasons distillates can go. We didn't have a big snowstorm on the ground, a lot of planes, so on and so forth. So there's good reasons for us to have a draw that's going to cause some kind of a drug. It's going to cause a drop in inventories, and if inventories drop, I think people. I mean, think about it. There's been no good news at all in oil for like a month. So if there's anything, even like a sliver of hope, I think you're going to get a nice pop. All right, that's what I think. It might be wrong, so we'll find out tomorrow. You know, it's been a long, long time since I made a big bet like this, so I'm just like, okay, I just think this is a good one. Craig says, do you have any expectation of how oil will move into today's close? No, I don't know. I think they're trying to force everybody out ahead of the inventories, but I don't think the API report is going to show the kind of draw that we want. I think it's going to only come tomorrow in the EIA report. I think it's a wild card what happens with API. So you shouldn't be in any kind of position you're not 100% willing to double down after a very bad move against you. And even so, that it may not help, because then if the next inventory goes down, it could be even worse. All right, so if you can, it's not the kind of game you want to play if you can't afford to lose a ton of money, like probably $2,000-3,000 a contract. But the upside could be $5,000 a contract, so I like it. I mean, for me, if the risk reward's even, I don't mind playing. And you don't often get a chance to make this kind of money that quickly. It's easy to make 500 here and there and 1,000 here and there. There's very rarely a chance to make $20,000. You'd have to trade the crap out of oil. In this particular case, there's kind of a chance that you can make some really good money if you're able to bet that much. But that's the point. Usually, I would never bet a 10 contract bet on oil is a complete wild card usually. So I wouldn't bet 10. I like to bet, you know how I play. I play 1,000 here and 1,000 there and whatever. I'm happy to win 200 or 300 usually. This one, I feel strongly that the odds are in my favor for a good bet. So, well, what the hell? And we'll see if it works out. I'll take one more here, see how much I like it. I can't stop myself. It's 10 cents above my price, but I still want them. So now I got 12 long. Oh, and by the way, when I do that, though, I'm keeping track. I got 2 at 47. Now you bastard. All right. So I'm buying at 47.95. I'm only right now playing the new contracts. I don't care about the old contracts. I just want to win on the new ones I'm adding. So I'm going to add 2, maybe 4, maybe 6, but I'm going to add a few down here. And as soon as we get a little bit of a pop, anything helps. I mean, any profit I make above 47.95, it helps. So we'll see what happens. Okay, we'll see if it goes any lower. All right, so that's that. Now, what should we be looking at? So here's what we were talking about today. Oh, meanwhile, I'm sorry. Getting back to, whoops, no, I didn't want to do that. There we go. Can we talk about the 5% rule? Yes, very good. Okay, good topic. So meanwhile, getting back to the indexes today, that's Nikkei. Ooh, that's a fun long also. All right. Well, you can't see the 5% rule here. Oh, I know what I can do though. I just see I upgraded my stock charts for you guys, so we have good indicators now. So if we go to SPX, see now I got my nice intraday chart. So, well, actually this won't work anyway. So the S&P basically, we topped out at 2090. All right, when ignoring the 93, that's just a little spike up. We topped out at 2090. We fall down to 2000. That's a 90-point drop. And now you want to use a calculator and say, well, let's see. What is 90 divided by 2090? And it's 4.3%. Well, so I say, oh, wait a minute then. How much is 2090 times 0.95? How much is a 5% drop? 1985. Hey! Wait, 1985. Oh, we didn't hit 1985 yet, but we should be using that line. And let me take a look at Monday's post. Monday. And I want to see what Jean-Luc put down on the big chart for the lines. There you go. So I want to see what's significant. First of all, we have a 90-point thing here. So what's half of 90 is 45. So at 45 more than this, so at 1990 is the 7.5% line. Those are significant lines. We don't write them here, but obviously any 2.5% move is very significant. So 1990 happens to be a very significant line. So given that, oh, where did I go? Now back to stock charts. Yikes. Now, given that, I'm now going to recalculate and say, well, now I know where we should be. 1990 should be my base. So 1990 times 1.05 is 2089. Well, what do you know? Funny how that works out, right? So 2090 is just about exactly 5% over the 7.5% line. So that is our next line. That's the next line we're going to care about. Oh, that was silly. I mean, that's pretty obvious, isn't it? It's a little confusing because you know you're basing off 1850, and then there's it's different way if you calculate from the top or the bottom. That's what gets confusing. But it doesn't matter because the point is things move in 5% increments. So what we have here is we now know that the move from 1990, which we think is a base, to 2090 is exactly 5%. Now, since that move is 100 points, that means what? With the 5% rule, we expect 20% retraces. So a weak bounce, which is a upward retrace of a drop, so a weak bounce is going to be 20% of a 100-point drop, which is 20 points. So now if 1990 then is our baseline, is where we expect it to stop on the 5% rule, then we'd expect to see a bounce of at least 20 points to 2010, to 2010, within 1 day. It has to be within 1 day. It has to be as fast as it went down, it has to come back. If it doesn't come back as fast as it went down, it's like a ball. It's like if you drop a ball and if it's a super ball, it pretty much comes all the way back to your hand, right? But if it's a regular ball, it's going to bounce maybe halfway, like a basketball. It'll bounce about halfway. If it bounces halfway, then you say, well, this thing's running out of energy, though. And then it bounces back down, and now it bounces another half. Then it bounces down, it bounces another half. Soon it's on the floor. It runs out of energy. That's the same kind of thing you'll see in the stock movements. You'll see these retraces, but if the retraces don't have enough energy to show you that they can make it back up as fast as they went down, then they're probably not going to make it all the way back up. And if they're not going to make it all the way back up, it means they're going to fail. Not only that, though, but now since I know that 1990 to 2010 is my first retraces of weak bounce, that means that 2030 is a strong bounce. And what's happening at 2030? Oh no, we're running into the 50-day moving average. So the 50-day moving average acts as additional resistance. And so if the 50-day moving average, in other words, if we have 2 days to get to this, to 2030, and then there's a 50-day moving average, if we're running out of steam in 2 days, we're dead because we're going to bang into that 50-day moving average and we're going to be running out of steam, and then we're going to go bam and fall right back down again. All right, so that's what you got to watch out for. And that's what the 5% rule is about. It tells you this stuff mathematically. You know, in fact, when I first started doing this stuff, I don't want to say I'm not a technical person, I'm an anti-technical person. I hate PA. When we used to do this, I didn't even used to have a chart. The 5% rule chart used to be just a bunch of numbers on a spreadsheet. And I said, these are your numbers. And then people started, people asked for a chart, and John Luke started doing charts for it, which is great. It's fantastic to have a visual for it, but I'm not a chart person, so I never used it that way. But all it is math. That's all it is. It's just looking at what this is an analysis of what a computer algorithm does when you program it to buy or when you program it to sell. All right, they're not all the same, but the average of all these algorithms together comes out to roughly the 5% rule. So when someone hits a buy button, they're telling their computer to buy, and it's going to do this and do this. And if people are still buying, it's going to do that. But you can see where it runs out of gas. The curve, you lessen the curve. So this run was made in the same amount of time as that run, but it only had half as much energy. That means you can tell it's faltering. And with our broader looks at the market, with our big 5% rules, which we have on the big chart here, with these lines, which are annual, these lines cover years of time. These are very strong lines. So when you run into one of those lines on the chart, you know you're going to hit some serious resistance, and that's what we have here. We have serious resistance. This part where we broke over 2090, this is bullshit. This is holiday, no volume crap. This doesn't count. This was Christmas and New Year's trading. Nobody counts that. That's just garbage. So really, this line never really got broken at 2090. It stayed. And now we're rejected at 2090 for the second time. This didn't even make 2090, but we're rejected for the second time at 2090. We're having to retrace all the way back to our next support, which is 1990. And now, if this doesn't bounce strong in 2 days, so by the time, we have the Fed tomorrow, so if it doesn't bounce strong really, if we don't have a weak bounce by tomorrow after the Fed, forget it. You're in big trouble. If we're not up back to 2030 or better by Thursday, when the Fed speak is done, when the bullish Fed speak is done, then there's a very, very good chance we're going to be all the way back to this, back to this line, which is your next support at 1960, and then below that, we're all the way back here to 1840. And 1840, I think it was 1840, no, I'm sorry, 1850 is the must-hold line on the S&P. That should be serious, serious support. If it's not, we're in trouble. But you see how great the support was here. Doesn't matter that it broke below it. That's a one-day trade. Who cares what happened intraday? So a bunch of idiots started selling. But the reality is it held. It held at the end of this day, and it held at the beginning of this day. Never really broke. So 1850 is excellent, excellent support. We don't expect to go below that because we're not that bearish. But you do have to watch out for this thing coming down further. So this, I think we're still trending down. Another thing I said to watch out for is you want to watch the length of these things going down. When you see accelerating sell-off, so in other words, this candle is bigger than this candle, then we had a pause day, but still the overall candle is just about as long. This candle is even longer. So if the drops are getting longer, then you're having accelerating move down. But what we have today, and I said that, you have to have a 1% drop today, and we're down about 1% now. If you have a 1% drop today, that's less than yesterday. That means we're decelerating, and that means this line is very likely to hold, even if we have a bad day tomorrow. So we're hoping this is going to hold. But as far as a bounce, as far as watching it right now for a bounce, it's only going to be impressive if we're over 2010. Anything under 2010 is not impressive at all. And what happened to oil? Anything? 53.84. Oh, shit. Why didn't someone tell me these things? Oh, did I miss it? I did. I missed 47.63. Damn it. Now I don't want to buy. Now I'm pissed. I would have been happy to buy at 47.63. Holy crap. So this line's 47.75, so that's about as low. That's essentially holding. But see, Brent is getting worse. Exxon is holding more or less, and the dollar is getting a little bit stronger. And if the dollar's getting stronger, then I kind of forgive oil for getting weaker. That's okay. But see, now that I saw it spike down there, I'm greedy. I don't want to jump in at 47.85. I want to jump in at 47.75. So I'm going to reset my target. I'm going to watch 47.75, and I want at least that far before I add any more. All right. So let me see. I'm sure I'm behind on comments again. Let's see what happened. Okay. So we talked about the 5% rule a bit. John Molden thinks there's a high risk of a strong breakout in the dollar to the upside, assuming dollar rally over the next 2 years. Could you recommend fix and forget plays to take advantage? It's hard to do that with dollar. I mean, there's UUP, that's the dollar ETF. I mean, I do agree that the dollar, other currencies are, look, the ruble is essentially collapsing. It's falling apart. Oh, here we go. It's time to buy. Hang on. All right, we'll take that one if we can. Oh, bastards. They won't fill it. Oh, yeah, there it goes. Well, that was odd. Looked like there were a lot of other bidders, but then it filled mine. Anyway, where were we? Dollar, right. The Bank of Japan wants a strong dollar, so they're in favor of this. They're pushing for it. Actually, most countries want a strong dollar because everybody sells to us. We're massive importers. We want a strong dollar from that perspective because it makes things cheaper for our consumers, including oil, including a lot of things. It makes it cheaper. Interestingly, the second strongest currency, not really a currency, but the second strongest currency in the world last year was gold. The dollar was the strongest and gold was second. Gold held up against every single currency but the dollar. That's why we like ABX, by the way. We still like gold. Internationally, gold is still a good deal. As far as bets on a strong dollar, well, you don't want companies. Here's the problem though, for the S&P, they sell more than 50% of their stuff overseas. So the strong dollar is actually bad for their revenues because they have to convert back to dollars, and they show a weaker overseas sales even if they're selling things for the same price. So unless they're raising their prices, which they're not, and that's what you just saw in the CPI reports, they're not being able to pass through their prices. The consumer inflation is very low in other countries, even with their weak currencies. So given that situation, the strong dollar is not going to help the earnings of the S&P and things like that. So, the best bets for the strong dollar are really, I would just say the straight up UUP, but I don't like the trade. I mean, I think it's already had a run. If you had asked me a year ago, do I like the strong dollar bet? Yeah, we were buying UUP a year ago. I think it's already had a run though. So you're only getting like the last blast from, where's that now, like 91 or something like that, or 92? 90. All right, so it's not even 91. So basically, oh, I'm sorry, it is 91. This is just showing back. 91. All right, so you're at 91.60. So all you're going to get here is like the run from 91.60 to maybe 95. It's very unlikely to go to 100. So you're talking about 5%. So do you really want to sit there and screw around with a dollar trade for a 5% move? It's not that exciting, and the options on up aren't that exciting. I don't know what he thinks it can be. I mean, realistically, you have to assume the euro when it gets down to parity with the dollar, which is 10% from now. So 10% up for the dollar would be 100, and on the euro, that would bring the euro down to $1 per euro. At that point, that becomes a problem for everybody, and that would almost certainly end up getting rebalanced at that point. So I don't perceive a very large run, and then if you went to look it up as a trading vehicle, trade up, it's only at 24, so your bet is going to be that up goes from 24 to 26, 27, and if you're looking over 2 years, here's 27. See the spread? That spread indicates, when you see spreads like this, it indicates it's a crappy thing to trade. You got a huge wide gap here on the spreads. If you took it, it's at 24 now. So if you bought the, let's say these are 230, or let's say these are 225. If you bought these for 225, and if you were able to sell that for 110, I'm sorry, what is this? 225 is the 23s for 225, and you sold the 25s for 110. Then you're spending $1.15 on a $2 spread. So there's your. So if if you want to play, that's how I play. I would buy the 23s and I would sell the 25s because basically, look, you're at 24 now, so you only need a teeny tiny move on up, and you're going to make 90 cents off your net 110 spread. Is that the right number? 235. Wait, 225 minus 110 is 215. Sorry, 85 cents. So. I'm sorry, because I say this is not a big deal, but it's 85 cents divided by 110 is 77%. So if you want to make 77% betting on a strong dollar, that's all you have to do is just take that whole spread on up. All right, now there's going to be a little bit of decay to up, but that's why we're taking a conservative position. But that, there's your bet, and your net delta. So the delta on the 22s, I'm sorry, the 23, sorry. The delta on the 23s is 67. The delta on the 25s is 46, so your net delta is 21, which means you're going to lose 21 cents of your $1.10. So I'm sorry, the $1.15 you invest. So you're investing $1.15, and every dollar moving up, every 5% change in the dollar is going to cost you 21 divided by 115. So it's 20% basically, all right? So your leverage to the dollar is 20%. But since you're only spending $1.15 for the 23 calls, forget that you're capped on your gains, but you're spending $1.15 for the 23 calls. That means you're in the money. It means every penny move on the dollar is going to gain you. I'm sorry, every 5% move on the dollar is going to gain you 20%. Your leverage is 4 to 1 basically. And if it goes the other way, you're going to lose 4 to 1. All right, so that's your risk, though. Your risk is 20%. For every 5% move up on the dollar, you're going to make 20%. That's a nice trade with nice leverage. I mean, but that's based on that bullish premise on the dollar. It's nothing I would be very excited about. But I mean, a lot of people are very excited to make 77% in 2 years. So I wouldn't say it's a terrible trade, but you have to have that premise strongly in place. Any reports on holiday sales? No, we got the retail sales numbers today. We're not really telling you the holiday sales. You really kind of have to wait until there's a big retail sales report. I'm not sure when that comes out, probably next week. And that'll give us some idea. But realistically, you get a better idea, obviously, off of earnings. You want to see the earnings report for Q4 as people come in. But it's going to be a couple of weeks before the retailers start reporting. In fact, I don't think I saw any retailers reporting. We just did a look at those yesterday. We talked about earnings. Hang on, Control F. Earnings. Darn, I remember having that conversation with people, but I don't know where it was. I guess it must have been over the weekend. There were no particular earnings reports of retailers that I remember. It's mostly, even next week, there's hardly any retailers coming in. There's mostly banks and financials next week. The week after that, which is already, you're talking about next week is the 13th, 15th. So then you're getting into the 20th is when you first start seeing the reports from retailers. That's when you're going to get it. So the retail sales report, and let me just check for you. I do have these things, but it's not all on this computer. Certainly not this week. Economic calendar, let's check next week. Oh, there it is. It's January 14th. That's when you're going to get your December retail sales report. All right, so that's your best shot. That's going to give us some idea of what's going on. Although that's going to be a real messed up report because gasoline is retail sales. So you're going to have really weird numbers. You got to be very, very careful about what it includes and doesn't include. I should meanwhile check oil. Let's see what's happening. Shoot trade, active trader. Really? Oh, come on. There you go. What a tease. I'm going to remove, oh, fine. I'm going to take away my offer then. Screw you. All right, so now we have 14 long, $5,000. Oh, yeah, $5,000 from the open. Oh, for the day, it's down 26 now. Come on. I want 65. So these 4 or 5, if I get the 5th. Oh, yeah, here we go. Boom. There we go. So these extra 5 that I just put on, we started at 85. And we got some at 60, so the average of 60 and 85 is around, what, 70? So basically what I want to do now is I want to get out of these anywhere above 70 and hopefully kill those extra ones. I don't want to go into the close with the 5 extra. I want to get out of them, but I'm hoping that we get a little bounce back up before we close. Well, the thing really closes at 6. And we'll see what happens. But I think people are kind of betting the API report's going to suck, and that's what's reflecting there. Let's see. Yeah, just be careful, Mike, because it still can really kill us. I mean, this thing's in a vicious downtrend. There's just nothing good. There's nothing good looking going on here at all. The indexes are holding up though, so that's encouraging. If oil goes to 30, could I do buy? You know what? You're right. It's not a bad idea, Mike. I think we should probably put out some feelers and see who wants to get rid of some wells. Well, look, to some extent, oh, wow, look at that, 47.50. Now, 47.50 really better hold. I mean, that's a nasty thing to lose. This is definitely lower than I thought we'd get. I mean, look, it's lower than the support resistance line I thought we'd get, too. That's the base support right there at 47.70 or 47.75, really. That's incredibly low. Wow. I got to go one more there. We'll see what happens. All right. Amazon sold a ton of Prime subs. Well, that Amazon Prime is a fantastic deal. I think everybody should have that. Mike says 10 million, I think, so churn of 5 million households who will never go to a mall again. Oh, on what, Prime or something? Yeah, there was actually an article we posted in the news today about the dead mall phenomenon in the United States. I mean, it's just really incredible how many malls are going belly up now. In fact, I think you guys probably know what I mean when I say a dead mall. I mean, when I was in college, we had a dead mall in Amherst, and we called it the dead mall. This is back in the 80s. I have no idea what the actual name of it is. We had two malls. We had the mall, and we had the dead mall. Those were our two malls. And the dead mall had a movie theater, which we all went to. It was, it was a perfectly good movie theater. But it was eerily empty. Like, there was, like, nobody there. All the rest of the stores were pretty much empty. There were some things. They were usually discounty sort of things and people dumping stuff. God knows what they paid in rent. So we liked the dead mall. It had cheap food. It had cheap clothing. That's what we liked about it. But it was wild. I mean, it was just really oh, yeah. Oh, see, that's my break even now on the things we just added. So now we'll see what happens. I would like to obviously get back to like 48 and make a little bit of a profit on those 5. But anyway, so I used to say the dead mall, and people who weren't around, people who weren't from Amherst had no idea what we even meant by a dead mall. Now I think you say dead mall, and everybody knows one. It's like a normal thing. Like, everybody knows about a dead mall somewhere. That's bad. That's not a good thing. In fact, Jersey has the deadest mall in the world. It's the thing that was called Xanadu, the project they were doing by the Meadowlands. It never got finished when the market crashed back in 2008. The whole thing went bust, and it just never got finished. It was this massive, like, $2 billion complex that died in progress. After they spent $2 billion, it died. Well, that's, compared to the Rebel Casino, it's just as bad, really. But the thing is just nothing. It's just gathers dust. It's this gigantic mall next to the Meadowlands where you think there would be a good amount of people dead. Anyway, there is a definite thing where kids don't go to the mall. This is what gets me, though. I don't know what teenagers, they sit at home now. When I was a kid, when we were kids, what happened, though? When we were kids, what do? You don't want to sit around the house. It was boring. Now people sit around the house. They're chatting to their friends on the internet, and they're online playing games and so on and so forth. So I guess the mall isn't even exciting anymore for kids. My youngest daughter likes going to the mall. She's into shopping and buying stuff. But my oldest daughter has zero interest. We go to the mall. I say, do you want to go to the mall? She's like, nah. Because she's busy with her friends. She's got a friend in Canada. She's got a friend in Europe. She's got a friend in Asia. She's talking to friends all over the world. She can't do that if she's not home. So for her friends aren't even around. Like, they don't go to the mall together. They sit at home. That's how they converse. It's really strange. But anyway, so that obviously kills the trade. Not only that, though, but the other phenomenon is because my older daughter is 90% of the time online, she's not really concerned about clothes. She doesn't care about getting fancy clothes or makeup, and she doesn't need going out shoes and things like that. She's not into any of that stuff. It's not, it's not interesting to her. She's not antisocial, but, her big social life is with people online. And my younger daughter, too, most of her friends are online. She has a best friend who lives in town, but they're like one entity. My daughter and my little girl and her best friend are like joined at the hip, and even their online friends are joint friends of theirs. But they have a slightly different dynamic because that whole group likes to get together. They like to pick places and they con the parents into taking somewhere, and we all go somewhere and meet up, and they have a big meetup and they have a little party wherever they go. I just had a whole bunch of them over for New Year's. It's a different kind of socializing than we did, and that's it's really hard to relate to. It's like I can see when my parents thought what we did when we were teenagers was weird, because I think the difference in just a generation is severe. So anyway, so that's what's causing malls to die, is the fact that they're not a socializing place for kids anymore. It's a place where people go to shop, but then what is it? 10% of the sales are online now, so there's a need for 10% less stores. Plus, you have so many strip malls and things like that everywhere. These mini malls, the outdoor malls. That made a resurgence. For a while, strip malls were dead. You wouldn't go. You would never occur to go to a strip mall to shop. Not where I live, anyway, in the Northeast. We would never go to a strip mall to shop because you would go to a proper shopping mall and shop. Now there's a lot of strip malls that people go to, and that kills the big mall kind of premise also. So yeah, this is why it's retail's a tricky, tough business. I wouldn't touch it. It's a really scary thing, and yeah, they'll never go to the mall again, like Mike's saying. I mean, people will never go to the mall again. It's over for a lot of that. And the more my children's generation grows up, the less interested they are in going out and shopping. Like, well, why would I go out and shopping? You got to go out there and carry it. Meanwhile, Amazon, tomorrow, you order something today, and tomorrow they put a gift wrap box on your door. So you hand the present to someone and go, here you go, I thought of you. Or you don't even do that because you just send it to your friend directly. If you want to buy something for someone else, send it to them. If you want something for yourself, you hit the buy button, and within 2 days it's found on your door for free shipping. How do you compete with that? Not only, and also, I think there's tax now, but I mean, a lot of things there's still no tax. Like Jersey has no tax on clothes, so there's no tax for clothes that they order. Anyway, strong dollar premise is unraveling, says Todd, of the U.S. carry trade. Well, that's a weird thing. And that carry trade goes back and forth. It's a very strange thing, but I think the general premise of dollar bullish does make sense. All right, and yes, I'll work with you as much as I possibly can. Let's make sure you make your money on that up trade, or we adjusted so you do anyway. All right, so oil had a brief bout of pretending it was going to go up, and now it's dead again. Mike says, can't get the girls off the iPad. That's right. It's funny because my older daughter, she actually uses her laptop mostly because she's into, they play games here. That's why she plays Warcraft and some other games with her friends. And so they were all on with the headsets, and then they all play. And I wonder if I should worry about it sometimes. But I'm like, you know what? When I was, 14. When I was 14 years old, if I had the opportunity to sit at the computer and go on quests and go slay dragons and do it with my friends where we're all chatting and playing the same game at the same time, I think I would have spent most of my time doing that too. That's just so cool. It's hard to imagine. Like, I'm not sure if I would have really competed with baseball from there. I really, mostly I played baseball and football when I was a kid. That opportunity just wasn't even there for us. So that's what she does with her friends. They go out on quests. I don't really think it's a terrible idea. And my younger girl, though, it's interesting. She actually doesn't even use her iPad. She uses her phone. It's all about texting and Twitter. So my little one's 12, and she's text Twitter, and that's all she does. And Snapchat, because they like to take pictures and show everybody what they're doing. So anything they are doing, they share it with their friend. It's really weird. So Christy says, do you follow the bond market? No, I don't really follow the bond market other than like just generally looking at what the rates are. So I don't play ZB. I think generally rates have got to go up. They can't stay this low. They can't. It's unhealthy for one thing. I think this year is the year, well, we already did the Secret Santa inflation hedges. I think this year is the year you're going to start seeing inflation sort of creep back into the market. You can see the pressure in the emerging markets, and of course it is because of the declining currencies. And here's the problem for the American companies. Like, all these consumer product companies that are selling stuff overseas are selling into crazy weak currencies, and they're not making any money. You don't make any money when you get paid in rubles. You got to, if you're getting paid in rubles, you got to raise the price of what you're selling every 5 minutes. So think about that. So you have to look at it from that perspective. That's what inflation is. So for the people who are in rubles, the people in Russia, they're going to have inflation. The people in India are going to have inflation. The people in Japan are going to have inflation because eventually the companies selling to them say, "Hey, dude, I got to make some money. I can't just keep shipping you stuff and letting you pay me in your stupid currency. And that's how inflation starts creeping in. You're going to start seeing it, I believe, and this is why we're bearish now. I believe we're going to have a bad first quarter because of this exact reason. You're going to have a lot of very negative comps on foreign currency. Anybody who's selling into foreign markets is going to have some negative comps. It's not going to be offset by the American consumer. We're not back that much. And that's going to cause some problems, and I think you're going to see that going forward. And the only solution to that for the companies is to begin to cut some production, make less goods and services available, and charge more for them. Because producing more and selling more crap to people who have no money doesn't help. It's the same problem the oil guys have. It just causes a deflationary spiral. And it's all going to have to snap back at some point, and I think we've overcorrected enough. You have the central bankers have been printing mountains and mountains of money, and eventually that money's going to start doing something. We have more people working, and if the people keep working, here's the trick though. The last couple of years we put people to work, and most people who want jobs now have jobs. Like I don't know anybody who's chronically unemployed. Most people I know who are looking for jobs in my town, which is a middle-classy town basically, I knew guys who were unemployed for like 2 years. I knew some guys who just could not find a good job. I mean, they did this and that, but they were basically unemployed. Those guys all have jobs now. People have gotten back into the workforce. People who really want a job have gotten jobs. So I think, but the thing is, you don't feel, first of all, when you're out of work for a long time, you get a job, first thing you're doing is paying off your debts. The second thing you're doing is you're still worried about your job. How long will this job hold up? How long will I be able to keep working? So it takes a long time before people actually change their attitude and begin to trust it enough to want to, oh shoot, hang on a second. I'm obligated to at least sell one just to lock that in. Yeah, and of course it doesn't take it. There it goes. All right, so see, that's how they went before. We were down 5,000. Now we're back to like 1,300. Oh no, now I'm sorry. The profit for the day is now $1,000. So the $6,000 move just now in oil. On that amount of contracts anyway. And don't try this at home would be the thing to say if you're not into having a very large portfolio with this kind of movement. See how fast there goes $1,000 like that while I'm saying it. But see, my hope is that I'm going to say, oh, there's $50,000 like by in a week or two. I'll be able to say, oh, look, $50,000. All right, so where were we? Oh, frick! I just lost my total track of what we were saying. All right, let me read this question while somebody reminds me what I was talking about. Do you believe the U.S. can become a net exporter? Will shale hold up and is it real? I think I think we are. Well, we're not going to be a net exporter. That's not even possible because we're currently exporting gasoline though, and we're already exporting gasoline. We make more gasoline than we use, but we still import like 8 million barrels a day. Oh yeah, I mean, if when means oh yeah, the inflation, right? Thank you. If you mean when as in ever, yeah, because eventually we're going to become more and more energy efficient at home. We're going to keep producing this oil for another 20 or 30 years at this kind of rate, and we'll probably drop our consumption of oil by half in the same amount of time, so we will end up exporting oil. But it's a long-term thing, and by the time we really start exporting oil, we're going to start running out of oil. So we only have about 20 years worth. And then it'll sort of peter out anyway. But by then we'll be, believe me, it's going to be very important for the next 20 years for us to keep getting more and more solar power, electric power, this and that. We're going to have to just move away from oil completely. But at some point we will have too much oil because it will, according to Moore's law, solar cells should get efficient enough that probably half the homes in America won't be using any electricity from power plants, and that's going to cut a tremendous amount of consumption. Then you have more electric cars on the road because obviously if your energy is for free from your roof, why would you want to go buy gas? You get an electric car. So more and more people will get electric cars, and there'll be less gas consumption, so on and so forth. And eventually somebody will figure out how to get trucks to run on electricity, or at least on liquid natural gas, which will cut consumption also. There's lots of things that can be done. Fuel cells also in the works. all this stuff in the future. Oh, and also Lockheed Martin, LMT, they say that they're on track within 5 years, I think. They expect to be able to have a commercial fusion reactor up and running. 5 years, 2020. Commercial fusion reactor. If that actually works, over the next 20 years after that, we will need zero fossil fuels to create electricity in this country. That's huge. You know, we start knocking that out, the whole world's going to change if that happens. And it's not just this country, obviously. Then once it happens and once it works, the whole world's going to go that way, and it'll be great. So, you know, if there's one thing I believe that will save the world, it's fusion. And Lockheed Martin, they firmly, you know, I read some papers, they firmly believe that they're going to have a working fusion reactor. Total science fiction stuff. They think they're going to have it ready in 5 years. So that's really cool. Now, last thing we'll talk about, we were talking about the inflation situation. You know, all these central banks have pumped trillions and trillions and trillions of dollars into the economy, but the money's not moving. The velocity of that money isn't moving because, I know what I'm talking about, the unemployment stuff. Because a person who has a job, so think about it, in 2008 and 9, everybody lost their jobs. In 2010, we were kind of stagnant. In 2011 and 12 and 13, people started getting their jobs back. But what did they have to do? They had to pay off the debts they accumulated while they're unemployed in 2008, 9, and 10, either unemployed or underemployed. They had to pay back their debts. They had to feel secure in their jobs, but now they're just starting to be like secure in their jobs. If they see their company hiring more people, they don't think they're going to get fired, so they start planning for the future, and then they start actually saying, oh, you know what, I will borrow some money, I will go get a house, I will go get a car, and that's when you get real consumption, because when you buy a house, especially, you're buying a house, you're buying couches, you're buying refrigerators, you're buying this and that, you're buying drapes, you're buying carpets. That's what really moves the economy, is new home sales. New home sales drives the economy. That's the most important thing on earth, is new home sales. That's not picking up yet, but I think that we're just about there. Once that happens, that's when the money, all this money that's sitting around doing nothing, like in the banks and in the corporate treasuries and all that, when that money starts to move and flow into the economy, that's when you start heating up the economy for real, and that's when you start getting inflation, because there's suddenly a demand for goods and services and people are doing stuff again. That's what's going to ignite inflation here. And not bad inflation, like good inflation, 2, 3, 4% is good. I think we're going to actually overinflate, though, because, well, first of all, for one thing, it's good to pay off the debt when you overinflate. But for another thing, I just think we're going to overinflate because there's just way too much money. There is a tremendous, tremendous amount of money. So we shall see what happens. But my bets, you know, we have the Secret Santa's inflation hedges. If you go on our site, let's see. I think I put them under, maybe not. Let me see if it's under portfolios. Portfolio reviews, nope. Okay, that should be there. See, that's messed up. That should be in education. That shouldn't be there. Education. And if you go to education and you look at the educational archives, oh, well, that article is there too. So paying yourself a dividend, and then we should have how to get rich slowly, another good article. How did that get there? That's weird. You know, I'm very embarrassed. There should be Secret Santa's inflation hedges somewhere around here. Oh, I'm so mad. Okay, well, I screwed up. I will fix it, and I will put it into the portfolios, because we should have Secret Santa's inflation. In fact, I'll do that right now. Why not? Let's see. When did I write that? Did I write that in, I must have written it around Christmas, so I wouldn't have called it Secret Santa. There they are. Secret Santa's inflation hedges. So these are the places we like for inflation, and let me just put it where it belongs and make sure it works. Portfolio review. That's where it's and education. It should be in education too. No, it shouldn't. It's not educational. Okay. It's not educational. It's a portfolio kind of thing. So I'm recategorizing it. And now we'll go back and we should be in the right place. So as I was saying, if you go to the virtual portfolio tab, there it is, Secret Santa's inflation hedges, okay? So what do we look at? We looked at different kinds of ideas for inflation. So we talked about home price inflation, and that was doing the XHB, which is a housing ETF. We talked about hedging for fuel using XLE. I got a lot cheaper since then also. Hedging for food inflation using DBA. And also hedging against me raising my fees again, which I like that one. And for that one, we were using ABX. All right? So in ABX, we had a trade. This is also a great inflation hedge in general. You're just playing on gold to get more expensive. And we like the 1015. I'm not sure what ABX is right now. Let's take a look. And somebody asked me about ABX before, but you never clarified what you were saying. 1129, how fantastic. Wow, that means this trade is already kicking ass. I forgot what date this was. This was December 21st. So the trade was the 1015 bull call spread in 2016. Now that's more aggressive because I expect gold to go up this year, not wait too long. The 1015 bull call spread was $1.60. And selling the $8 puts for 70 cents. So let's see where that is. The 1015 bull call spread for 170, 160, and the 2016 8 puts. And I'll just show you how easy this is. It's a very simple setup. You can read about it in detail. That's why I want to go take a look at it here. So the 10s are now, let's say, 265. The 15s are $1. So that's 165. That's actually the same price. So basically about the same price, 160. And the short $8 puts are, they're not 68 cents. They're somewhere between, let's call them 60 cents. So we had a 160 entry and so, oh, well, 10 cents. This trade is up 10 cents. But you know what? It was net 90. It's already up 10%. That's how you stay ahead of inflation. So this trade was net 90, and now it's net $1. So it's up 10% since December 21st. That's what an inflation hedge is supposed to do. It's so simple, okay? So I want you guys to really read this. This is a big thing, and if you want questions about it, I'd be happy to talk about them in detail next week. But these are basic inflation hedges that anybody can do. I've got the amounts here. We talked about very specifically the amounts that you can do, how much you expect to gain, so on and so forth. For this ABX trade, oh, I know, we were talking about offsetting the cost of a membership. I guarantee it's not too many people took me up on that. Like I said, if you sign up for a full year membership here and you follow this trade, if this trade does not give you a profit of $2,500, I will give you a free year membership to make up for the fact that you didn't get your money. That's how confident I was in this trade. Now already, this trade is up $250 in 2 weeks. That's what we call on track. And this is a nice conservative trade that we set up as an inflation hedge. All right? And the reason I liked it so much was because boy, the members on the site know that I have been pounding the table on ABX for like the entire winter and for the fall. I mean, basically, the whole time it was down, I've been saying ABX, ABX, ABX. It's the best way to buy gold. And the last thing I'll tell you is I'll say ABX again, because it's still the best way to buy gold. Because ABX, Barrett Gold, you see where they were? When they came down around here, I started going crazy. I started getting ABX fever, and I've been screaming about ABX all the way down here. Anything down around this price like this is fantastic. Now, why? Because ABX has 140 million ounces of gold in reserve. All right, so how much? 140 million ounces of gold. So 140 million ounces of gold at how much per ounce? What are we at? $1,200 an ounce? At $1,200 an ounce is $168 billion. $168 billion. That's how much gold ABX has of proven reserves. That's not speculative. That's what they've proven they have reserves in their mines in the ground. They might find more, but they've already proven $168 billion worth of gold. Now, we go to Yahoo, and we say ABX. And you can buy this whole company for $13 billion. That's why I like them. Now, the trick is that it doesn't matter how much gold they have in the ground. What matters is how much it costs them to pull it out of the ground. And that's the extraction cost. And we've talked about this before in an earlier seminar, but the point being, it's the net cost for them. So basically, right now, Barrick costs them about $1,050 to pull gold out of the ground on the average. So they make about $150 an ounce. But you know what? $150, 150 times 140 million is still 21 billion. So at $1,200 an ounce, they make $21 billion. Now, they don't make it all at once. They'll make $2 billion a year. But would I want to buy a company that, you know, if you figure 10-year life on the mines, and they buy more, obviously they take some of their money, they buy more mines, so on and so forth. But do I want a company that makes $2 billion a year for $13 billion? Of course I do. That's a ridiculously cheap price. It's a P of I don't know, 7? 6. P of 6, 6.5. But here's the funny thing, though. The same 140, what if gold goes up, though? What if the $140 million of gold goes up to $1,500 an ounce? Then where are they? Now they're making $210 billion. They make 10 times more money if gold goes from $1,200 to $1,500 an ounce. They will make 10 times more money. They'll make an embarrassing $20 billion a year on a $13 billion market cap. So when you buy ABX, you're already hedging the crap out of gold. And the great thing is you're buying a miner that has tremendous gold reserves, and because they're so large and because they have these reserves and because they can get a bank to lend them money against the reserves, when their competitors who are weaker go out of business, they can go and buy the mines that their competitors have for 10 cents on the dollar. Oh, thanks, Mike. I didn't know oil was going up. I want to take my money and run because I did plan on getting out before the close. Where were we? Active trader. Thank you very much. I appreciate that. Ooh, it's even better. Oh, it's even better. Wait, come on. Oh, it's even better. Look at that. I wouldn't even fill my thing. There goes 1. There goes 2. I got 3 more to sell, so I better sell that. Come on, don't be a bastard. This is exciting. Oh, wait, I didn't hit it. I'm like, why aren't you taking my... Yeah, there goes that one, too. 15. There goes that one. Nice. Look at that. 5,000 bucks. Decent. This is great. Oh, just missed it. Thing moves fast, huh? Oh, and down she goes. It's crazy. Oh, I'm at 10. Oh, thank God I didn't sell that one. I wanted to be at 10. So there you go. Wasn't that fun? This is freaking insane. So now I'm thrilled, though. I got rid of my extra contracts. I've lowered my basis again. I don't even know what it is right now, but I think I guess my basis must be because we were at 15. So when we were about here, so my basis is now around 48.15 or 48.20. So I'm thrilled with that. I've got my 10 contracts at 48.20, and when we started the day, we were up at 49.20. So I've lowered my basis $1, and I've got the 10 contracts I want. That is the perfect way to end my day. And notice I'm not greedy. I just wanted to get out. I only wanted to make a little bit of an adjustment. Once I start doubling down, once I start adding, the first thing I want to do is get out with a small profit. Because those small profit, it decreases the net amount, the net cost of the ones I have left. All right? And look how fast that moves now. I mean, this is a serious amount of contracts. It doesn't take very much for this thing to shoot up. So hopefully this will all work out. And Brent Crude should pop back up too, so everything's looking good at the moment. Boy, thank you, Mike. You just got me right where I wanted to be. So where was I? ABX. Anyway, so ABX, fantastic. You know, this is a thing people don't understand. You're already having their leverage to gold, but they also do something that you don't do. They're hedged to gold. Like, they know how to hedge. So they're taking away the risks for you. You're not only getting their upside leverage, but their management is hedging the gold. So as gold goes up, they sell some and they contract it out. As it goes up a little more, they sell some more. So they might not get 100% of the upside participation, but what do you care when you're leveraged 10 to 1 on gold with them? Okay, they lock in their upside as it goes on. They sell forward contracts, and because they've got the gold to honor the contracts with. They sell forward contracts as it goes up. So they're essentially selling calls on gold. Every time gold goes up $50, they'll sell another 3 months worth of gold. So they lock in the high prices as it goes up for you. There's no better way to buy gold than to own ABX. It's the best. All right, it's so good. I guarantee people they would win. Guaranteed. Who does that? I guarantee the trade. All right. All right. That's going to be it for today then. That was a good session, I think. Yeah, wow, we had a lot of people. I guess that's because this one was free. So anyway, those of you who came in for free, please consider, joining us. Come check out our memberships. We do all kinds of fun things every day. And we do these things every week at 1 p.m. It's Tuesdays at 1 p.m. is our normal time for these webinars. We change them once in a while, but usually this time. All right, thanks everybody for coming, and have a lovely day. And good luck on oil for those of you who are still long.